Welcome to What School Should Have Taught You, a podcast where I share with you all the lessons you need to know about building true wealth. I'm Jeremy Anazzelli, and we're going to be discussing today revenue account investing versus capital account investing. You may never even heard of these terms before, but if you're investing or developing in property, knowing the difference between the two could make a massive difference to your bottom line. In this episode, we're going to explain what the differences are and what you need to know.
Everything school should have taught you in one place. With a property portfolio of over 17 million and an accountancy firm of over 16,000 clients, as well as being an accountant to some of the wealthiest people in Australia, Jeremy Anazzelli will be sharing his lessons on everything school should have taught you so you can build the life you want.
Now, it's two terminologies that you may not hear. We believe as an investor, when we buy a property and we hold it for longer than 12 months, we get a 50% discount and we pay tax at our marginal rate or potentially a corporate entity's marginal rate. Now, it's very important we understand the two, and it's all about our intention. I'm going to go through with you about two examples to really give you an understanding of what the difference is and how to apply whether you're revenue or whether you're capital. We'll start with a capital account investor, which most commonly people are. They've bought a property, they've decided to hold it for 5 years, they've rented it out to one tenant, two tenants, three tenants. They may have built a granny flat on the property, got some auxiliary rental income, and continuing to hold it for a long period of time. Doesn't have to be 20 years, could be 5 years, could be 4 years. But they've done nothing that says that they're trying to carry on an enterprise. They've just simply bought a property, received the rental income, paid the expenses, and claimed a bit of passive income or potentially negative gearing in their return. They have a full-time job, working hard, looking after the family. Most people are capital account investors. They get a 50% discount, pay taxes accordingly if they ever sell the property, maybe extract some equity and continue to invest. So a very common way to be a property investor, capital account investor. But somewhere along the line, many investors move from capital account investor to a revenue account investor. And that could be that they want to change the way they invest. They want to change their journey. And I see this a lot with inside my client base. They'll buy their 2 or 3 or 4 properties. They get that itch, they get that bug. They may have watched The Block and they really want to start doing some renovating. They want to start doing some small developments. And this is where things change along the line. This is where you may now move to a revenue account investor. What's a revenue account investor now? A revenue account investor is a person or an entity with the intention of carrying on an enterprise, with the intention of buying a property, developing that property, and maybe selling that property in the immediate to short term. Now, you may buy, you may build, and you may hold for a long time. That's conducive with being a capital account investor. But a revenue account investor will buy, build with the intention of selling straight away. They may claim the GST along their journey and they may have to pay GST on the sale. So it all comes back to the intention as being a revenue account investor. I'll give you a really good example now. Client of mine, they bought a property with the intention of being able to build and sell. Bought the property, renovated the front of the house, sold it fairly quickly, subdivided the rear, built on the back, and then had to pay GST when they sold. They did get to claim back the GST throughout the portion of the build, which was giving them some cash flow to help pay for all the costs. But when they sold the property, they had to determine to the tax office how they would remit the GST, whether it was GST in full or GST as what they call margin scheme, which is a portion of the sale price less the purchase price, not including stamp duties or incidentals, and that's where margin scheme is calculated, which is the GST that the client had to pay. So it's very important when you're buying a property, you need to really create that intention and understand your intention. If your intention is to buy and hold long term, collecting the rent and paying the expenses, you will in most circumstances be deemed as a capital account investor and CGT concessions will apply, which is brilliant. And again, how most people invest in property. But if you've bought a property with the intention of to buy it, potentially build it, subdivide it, or add substantial value and sell it straight away, and you're doing this as part of carrying on an enterprise, then you may be seen as what they call a revenue account investor, where no discounts are applicable. GST might be applicable at the sale, and this may impact your bottom line when it comes to the amount of tax or GST that you need to pay. So it's very important before you buy something, you must consult with your professionals to understand what is my intention and what's the best structure to do this in. That will then dictate the amount of tax that potentially you might save or might have to pay at the end of the journey. And it is important to structure things the right way. Generally speaking, a lot of my clients who are on a revenue account investment basis will conduct their activities via a company, because we do get some better tax rates and it gives them an opportunity to roll that money into the next development. But if you're investing long term, could be beneficial and worthwhile to do it in your own name for a bit of that negative gearing benefit if there is so, or potentially inside an investment structure such as a discretionary trust. But that structure is worked out after you understand the intention of what you're looking to do with that particular property. Again, revenue, more development, carrying on an enterprise, lots of taxes that need to be considered, such as GST, and tax at potentially the corporate rate or your own marginal rate, which is ideally what you don't want to pay, or capital account investor, where you do get that 50% CGT discount and you're doing what normal Aussies do every day. I'm Jeremy Anatzelli, and that is what schools should have taught you. It's a short snippet of revenue versus capital. Don't forget to hit that subscribe button if you're on YouTube. And if you're listening on iTunes and Spotify, don't forget to follow us. Thank you very much. Look forward to seeing you on the next episode.